Since my last video, a lot has changed, like the time change, unless if you're lucky and you're in a state like Arizona. Also, winter has seemed to hit my state. Here in New Mexico, I live in Albuquerque. It's been snowing, and there's something else big that happened. Oh yeah, the election. And this election is having a negative effect on the real estate market, especially a few specific REITs. So I want to talk about if we should be worried. And we're going to talk about Realty Income and VICI specifically, and if I'm worried or I think it's nothing to be worried about, nothing to see here, and if I'm bullish, if I'm bearish, will I buy anymore? Will I sell? I want to talk about these REITs because a lot of us hold these REITs, especially those that watch this channel, because I talk about these companies often. I hold them in my portfolio. So what's going on? Why did they fall after the election? Well, let's start with the fact that these stocks, these REITs, are going down because treasury yields are rising. Yes, you heard that right. And this also signals that investors think that interest rates could go up in the Trump administration or at least remain elevated. So maybe they think inflation will come back a little bit. And when you have higher treasury yields, that means that bonds will be competing with the REIT stocks like Realty Income and VICI, which pay out more than 90% of their profits as dividends, and higher bond yields could attract dividend investors back to bonds. But we also have to think about the other side of it. Realty Income and VICI do have resilient business models, each in their own right. They both use triple net leases, which is very beneficial and protects us, as well as you have Realty Income, which has standalone retail properties that are recession resistant, like convenience stores and drugstores. You have VICI with iconic one-of-a-kind properties like MGM Grand, Caesar's Palace. So there are some upsides that will help them should these interest rates go up, should these treasury yields go up, should inflation come back. Of course, it wouldn't be the best situation for them. But the other reason that rising yields are a challenge for Realty Income and VICI are that these companies borrow money to buy new properties, so higher interest rates will raise its interest expenses. So now you can kind of see why these stocks have kind of tumbled after election, as people think due to the winner, Trump, that it's going to cause some higher interest rates, maybe some inflation. That's, of course, to be seen, and I think that's just people's emotions playing out, and I never like to go off of emotions. So should you be worried? Let's take a look. Let's take a look at VICI. Year to date, they're down 4.75%. Definitely underperforming the market. It hasn't been a good holding so far this year. Both VICI and Realty Income reported earnings recently, so let's go over VICI's. You'll see here their AFFO, adjusted funds from operations, grew 8% year over year. That's pretty decent. And then their AFFO per common share grew 6% year over year, which is also fairly good. It's not amazing, but it's also not signaling any negatives for me. Now, revenue grew 7% year over year. That's pretty solid. And, these are REITs. So you look at the technology sector and other companies, you expect those to kind of grow more in the double-digit range. But with REITs that are steady and those that pay out these massive profits to shareholders, they have a lot to deal with. So 7% is pretty good. Net income grew 32% year over year. So that's pretty amazing. And the long-term debt remained flat year over year. So I think that is good. Now, should you worried? I don't think so. First of all, this company has durable cash flows as shown through its earnings and the positive year-over-year growth. Not only that, but VICI collects 100% of their rent and has since the formation of this company. And that is something that is awesome to hear and an achievement that should make you happy as an investor. As well as their dividend. They have a really good dividend at 5.4%. That's the yield. And they grow it pretty well for a REIT. The last year, they grew at 4.22%, and over the last 5 years, they've grown at 7.77%. That's basically giving us all raises in our dividend passive income. Their payout ratio is also low at a 64.07% compared to the REITs market in general, so that's a good thing. Now, another reason why I'm not worried is the global gambling market is expected to grow from 540.3 billion in 2023 to 744.8 billion in 2028. Now, some major catalysts influencing the gambling industry include the legalization of gambling, rapid urbanization, increasing use of social media, and increasing involvement in sports betting applications. Now, on the flip side, things that can hurt their growth are growing taxation on casinos and strict government oversight on the gambling industry. But it does look good as far as the outlook and the growth in gambling in general. Now, luckily for VICI, their properties offer way more than gambling, so they can catch the growth in gambling, but offer protection against any challenges that may arise in this area, as VICI's properties are unique and they cannot be recreated, as the buildings themselves are unique and iconic, and so is the city the majority of them sit in, which is Las Vegas, Nevada. I mean, you cannot recreate a Las Vegas, the entertainment capital of the world. None of this can be replicated. They just have too many things going for them. They've acquired, sports and just so many things. So this is another great reason, looking at these properties that VICI holds that are iconic and irreplaceable. Also, VICI's properties offer vast entertainment options, from dining to clubs to shows to conferences, golfing, bowling, indoor water parks, and more. People love entertainment and experiences that won't stop, and VICI offers the best of the best, in my opinion. It's a long-term hold for me, and I think long-term results will be excellent. So no, I'm not worried about this company, and like with any sector, during struggles, those of the highest quality survive, they get through it, and then they thrive on the other side. So if we do have some years of higher rates of the yields of treasury bonds and stuff like that, this company will survive and it'll come out at the end and thrive. It's the others you have to worry about, the low quality ones, but to me, VICI ain't one of them. Now, as far as its price target, it's been raised recently to $35, and we will see here as an upside potential of almost 12%, and it's pretty much in a buy range. So will I be buying? I will tell you at the end, but let's talk about Realty Income first. Now, this company year to date, its stock is down 2.68%. So again, it's been underperforming the general market. Not a fun thing to hold as an investor. And if we look at its earnings and its financial data, its AFFO grew an impressive 27% year over year. But there is a stipulation here that I will talk about in a little bit, because we're going to compare the numbers of VICI and Realty Income. So moving along, its AFFO per common share grew 3%. Its revenue grew 28% year over year. And its net income grew 16% year over year. And that long-term debt grew 89% year over year. Yikes. Again, I'm going to repeat, just like with VICI, I'm not worried about Realty Income. They hold a 98.7% occupancy rate, and they've held that for the history of the company. They always keep it towards that high end in the 98 to 99 percentile. That is dependability. That's stability. That's showing that they can really manage this number very well, and that adds confidence for us that they can continue to do that going forward. This also marks their 30th year on the New York Stock Exchange. So this company has a proven history. With Realty Income, you're getting a very stable REIT with solid growth. Even though they have been around a long time, does not mean they cannot grow. I do not like when people say that about companies. There's always opportunities and avenues to grow. Now, Realty Income is expanding into experiential properties themselves, along with other areas. So we're talking about, casinos and I think data centers. So don't underestimate them, is all I can say. And don't take a young VICI as one that will be a guaranteed outperformer over Realty Income. Instead, I see VICI with the more potential, but with a little more risk, and Realty Income with adequate potential, but much lower risk. So it's kind of like a best of both worlds. That's why I hold both of them. And then I want to share what the CEO of Realty Income said on their earnings. They said, our third quarter results reflect disciplined execution of our strategy and the inherent benefits of our global platform. This company is global. They have properties outside of the US, a lot in Europe, And he goes on to say, supported by improvements in the investment environment and solid operating results, we see a robust pipeline of opportunities. As a result, we're pleased to increase our 2024 investment volume guidance to approximately $3.5 billion and raise the low end of our AFFO per share guidance to a range of $4.17 to $4.21 per share, reflecting a 4.8% growth at the midpoint of the range. Looking ahead, Realty Income is pursuing a wide range of growth opportunities, including capital diversification initiatives to further enhance the reach and scale of our proven platform. So right there, the CEO believes this company still has a lot of growth baked into it, potential, shall I say, for the future, which, again, I'm telling you, don't think because a company's big and old, it can't grow. It can. So should you be worried about Realty Income? No, I'm not worried. I think this is another high-quality REIT that will survive any turbulence in the real estate sector due to its proven history of surviving some tough years. Now, with its dividend, it has a yield of 5.38%, so around VICI's, but its growth is a little lower at 2.93% over the last year and 3.03% over the last 5 years. Now, that payout ratio is high, but REITs utilize depreciation, which throws these numbers off, but I can tell you their dividend is safe. With its price targets, this company has a median price target of $64. Right now, it has about 11% upside potential. It's not as strong of a buy recommendation as VICI from analysts, but it's in the outperform range. And I do agree with both analysis on this. I think VICI is the better buy if you were to buy right now. Now, when we compare the two here, you'll see that when you look at the numbers of their year-over-year growth in these different segments, if you look at AFFO and revenue, you will think, wow, why is O outperforming VICI like crazy? Well, a REIT's AFFO and revenue increases when it acquires properties or develops them, as that creates increased cash flows, which flows through these two areas, revenue and AFFO. Realty Income acquired Spirit Realty, and that is being seen in these calculations. So you need to factor that in when looking at year-over-year growth. Realty Income's revenue and AFFO looks like it is leaving VICI in the dust, but in reality, it's been lifted up by an acquisition, so it's not a fair or an accurate comparison. Really, you can compare Realty Income's AFFO and revenue increases versus the debt increase, and that paints a different picture as the rise in debt far outweighs the rise in AFFO and revenue. Of course, the goal is that long-term, this acquisition will amplify revenue and AFFO far beyond the debt they took on to acquire this REIT. Now, speaking of acquisitions, that's how these companies grow. That's how REITs grow. And one reason is through diversification. So acquisitions can help REITs diversify their portfolios across geographic areas, industries, and types of assets. And then the acquisitions can help REITs develop new industries or tenants. So it's a good thing, especially if it works out. There can be some failed acquisitions, right? But I think these two companies have a good history of making good decisions. So in summary, I hold both these in my portfolio as seen here, and I have no worry about them and think you should not either. It's the low quality REITs you should worry about. Be sure to let us know if you know of any low quality REITs. Share them with the rest of us so we can have discussions about them. Doesn't mean they are low quality, because some others might be willing to come forth and provide some information that says otherwise, but it's good to share that. But VICI and Realty Income are high quality in my opinion. And you'll see here the other side of this election was it did shoot every other sector up. So I'm now 31% in the green. Just last week I showed you I was 28% in the green. So I'm up 3 percentage points, which is awesome. Now looking at real estate there, you'll see that VICI's in the green for me, 5.92%, Realty Income 3.71%. So really not great returns because I've held these companies for years, but VICI does have a high allocation in my portfolio of 15.52%, and O makes up 5.79%. So you can see just by this, I am more bullish on VICI. And I think when we had these high rates, it was the opportunity for us to acquire shares of these companies. I still believe that till today. So if this is another opportunity with rates staying high, eventually those rates will go down. Maybe not to record lows like it was, but they will go down, and that will benefit these companies massively. It will shoot them up eventually. So I am very bullish on VICI and believe their future is bright. as they have unique, high quality properties. They are more risky as they are not as diversified, shall I say, they're more concentrated, unlike Realty Income, but I think they are in an area with higher growth potential and their properties are very unlikely to see any downfalls. So I'm keeping my shares of VICI with their juicy, dependable dividend. I won't be adding more due to its high allocation in my portfolio, like you saw, unless if it drops below my cost basis. Then I'll have to do some analysis to see if I want to add more or not, to see if I think it's worth it, because there might be some better opportunities. I am also bullish on Realty Income, but not as bullish as I am with VICI. Realty Income has proven itself as dependable, and it offers a different type of property offering, mainly retail, that VICI does not, but they are starting to branch out themselves, which is where I see the growth potential. But they would need to acquire a portfolio of amazing properties like VICI in order for me to add any more to this position. And that would also be costly, though, and take years and years to see the benefits. I guess Realty Income is my weaker link when it comes to growth. Of course, it has the opportunity. Of course, you can't ever say that these big companies can't grow, but just looking at it up front right now, I think they are the weaker link. I think VICI has greater potential for outperformance, but it is a very stable and dependable REIT. So I plan on keeping it as well. I just will not add any to this one. Even if it goes below my cost basis, I don't think I will add. VICI's the one I would consider. I see too many other better opportunities, and like VICI, I will just collect a really nice dividend and deploy that cash where I want it, also from Realty Income's dividend. So let me know your thoughts on VICI and Realty Income and which one you would rather keep long-term and why. Which one do you think is the better investment? And also, do you have any worries, unlike myself, about these REITs? And do you think these higher yields that we're seeing today will stay high? Do you think we'll see inflation? Do you think that's going to be the outcome over this next year? I don't think that will hold. I think it's a short-term thing, but we'll see. Regardless, these are high-quality companies in their sector. I have no problem holding them. With that said, that's all I have for today. We'll see you soon on Mark Arnold's Finance. Thank you very much.